Is Warren Buffett preparing for a crash? Warren Buffett, a man who's built his fortune from buying and holding stocks. Warren today possesses more cash as a percentage than he did before the 2007 financial crisis. I was usually taught that as much as Warren likes his hot dogs, he doesn't sell. But guess what Warren is doing? He's doing the unexpected. Warren is selling. This has got a lot of people talking. Is Buffett preparing for a market crash? There are a number of things we need to look at to identify why Warren is doing what he's doing. Warren Buffett's recent moves, selling stocks. Buffett's been selling stocks big time. In fact, Buffett has sold 2/3 of his Apple shares, his largest position, and has unloaded over 266 million shares of Bank of America, his second largest holding. Over the past 2 years, he's been selling more than buying, which is very different from Buffett's strategy we all know. So what's going on? Are stock prices too high right now? To understand Buffett's move, we need to look at one of his key indicators, stock prices. Right now, the stock market is expensive. How do we know? One of the best ways to measure this is the S&P 500 PE ratio, the price of stocks compared to their earnings. Right now, that ratio is 30.61, which means prices are 30 times higher than the earnings of the companies in the index. Historically, the average has been closer to 16. So we're nearly double the historic average, meaning stocks are looking pretty pricey. In simple terms, stocks are expensive, and that's a warning sign. The Buffett Indicator, a major warning. Another key indicator is the Buffett Indicator, which compares the total value of the US stock market to the nation's GDP. Anything above 132% means the market is overvalued. Right now, the indicator is sitting at a shocking 201%. That's significantly overvalued. To put it into perspective, before the 2007 crash, this indicator was at 105%. In other words, the market today is more expensive than it's been in years, even before the last financial crisis, which is a red flag. So, what's Buffett doing? He's sitting on cash and selling off stocks. Now let's look at interest rates. Since 1981, interest rates have been on a one-way ride down, from as high as 19% to nearly zero. Buffett has often said, interest rates govern everything. When interest rates are low, asset prices, stocks, real estate, you name it, go up because there's little gravitational pull on them. But what happens when interest rates rise? Well, that's what we've seen recently. If interest rates stay high, they could put pressure on stock prices, making them fall. And then there's the yield curve. When the yield curve inverts, meaning short-term interest rates are higher than long-term rates, it's historically been a reliable signal that a recession is on the way. This curve has predicted every recession since 1969. Right now, the yield curve is deeply inverted. In fact, it's worse than it was before the 2007 financial crisis. The inversion is slowly starting to ease, but historically, recessions tend to follow within 6 to 18 months after such an inversion. This, combined with rising interest rates, is a huge concern. But it's not just interest rates and the yield curve that are raising concerns. Key indicators like consumer sentiment and manufacturing orders are showing signs of weakness. As of the latest data, 4 out of 9 leading recession indicators are flashing red. It's a warning sign we can't ignore. If these trends continue, a recession could be around the corner. Buffett's teachings versus his actions. So what should we do about all this? Well, Buffett's always taught us some golden rules. Number 1, don't wait for a crash to start investing. Even when markets seem overpriced, he's always said, don't try to time the market. Number 2, don't sell. Buffett has famously held on to stocks like Coca-Cola for decades because holding assets long-term is where the real gains lie. He also teaches us not to hoard cash because cash produces nothing. But right now, Buffett seems to be doing the opposite. Why Buffett is selling, a smart move or a sign of trouble? Here's the thing. Buffett isn't just holding on to cash for no reason. He's been selling stocks at what he sees as the right time, taking money off the table while taxes are low. Selling his Apple shares and cutting back on Bank of America is a strategic move. Why? Because he's positioning himself for potential market turbulence. Buffett is sitting on over $325 billion in cash, which makes up about 25% of his portfolio. It's the most cash he's held since before the 2007 financial crisis.
Could he be bracing for a downturn? So, what should we do? Should we follow Buffett's lead and prepare for a potential crash by holding cash? Well, we don't know exactly what's coming next, but it's clear that stock prices are currently high, and there are several risk factors out there. Maybe it's time to play it safe for a while, just like Buffett. Take some chips off the table, keep some cash on hand, and wait for the right opportunities. Thanks for watching. Please like, share and subscribe to our channel.